Good evening, friends. Hope you are well and doing fine. I, Ashok Kanawala, on behalf of HDFC Mutual Fund, with my colleagues, extend a warm welcome to all of you on this call to discuss our forthcoming NFO of the Manufacturing Fund. If you recollect the events over last 1 year, be it geopolitical or on science front, or on sports, or on the economy, or on the capital markets, you can actually feel that India is like a shining star despite all kinds of troubles and challenges happening in the other parts of the world. So when we talk about geopolitical things, we had a successful G20 presidency. On the science side, we had a successful Chandrayaan launch. On the sports side, we had a terrific display at the Asian Games as well as in the World Cup. Of course, we lost in the finals. On the economy front, we remain the largest or the fastest growing economy in the world. And in the terms of capital market, we have reached the fourth largest stock market by market caps last year. And again, on the FX reserve side, we have a record reserves today, nearly close to $650 billion, and so on and so forth. So India actually is progressing well, notwithstanding, as I said, the challenges outside the country. Now, what is in store for us? We have set for ourselves a target of being third largest economy in next couple of years and 7 trillion economy by 2030. Now, what does that mean for us? Economy will double in size in next 6 years. And that presents to all of us a set of opportunities in various sectors, in various areas of this country. And therefore, the concept of manufacturing. Why manufacturing? Right? As we all know that over last couple of years, or I would say decades, India had a very successful run as far as service industry was concerned, and we have become a sort of a globally forced to recognize as well as software services is concerned. But somewhere, when we look at the from a macroeconomic stability perspective, uh, manufacturing has a role to play in a sense that when we look at India's demographic dividend, young population, which requires a job creation, or when we look at from a economic stability perspective of having sort of a stable uh, current account balance, somewhere manufacturing needs to take next step forward. And therefore, the government in power have set its eyes on the manufacturing sector and has assumed, or at least is taking steps to make sure that manufacturing, which today roughly accounts for 15% of India's GDP, will become 20% of India's GDP by 2030. That makes manufacturing one of the fastest growing sectors or themes over next couple of years. So, if I were to say what is in store for us, manufacturing to our mind presents a very exciting theme of opportunity. And therefore, we have with us Rakesh Sethia, the portfolio manager for this new fund, who will take us through in detail why we remain so confident about this theme as we progress in the Amrit Kal, and therefore the opportunity for the people who are connected to the stock market. I invite Rakesh. Before I invite Rakesh, Rakesh has a background of nearly 2 decades in capital market, of course. Uh, for 17 years, he has been a research analyst and with a leading, uh, I would say, on the sales side, our firms like Morgan Stanley, HSBC, and has covered extensively the sectors such as oil and gas, consumer durables, telecom, logistics. And with us, he has been for last couple of years, and he will be managing this fund. So with this, Rakesh, over to you.
Thank you so much, Ashok Bhai, for setting the context, and thank you for the introduction. As you rightly highlighted, the need for the manufacturing has come from various factors, and the what manufacturing as an investment opportunity is in the context of the GDP growth. So when we are looking at GDP will double in the next 7 odd years, we are expecting the manufacturing GDP would roughly triple in the similar time frame, and which is why we are excited about the growth, and which is why we think this is a good investment opportunity for the investors. So in this presentation, in this three-part presentation, I will address that why we need manufacturing, why we feel that India can emerge as a powerhouse in the manufacturing, and will share some case studies around the same, and finally specifics around the fund and the product and the investment strategy. So when you look at the why we need manufacturing, so essentially you can say there are three key things for any government. One is the growth. You need a sustainable and inclusive growth. You need large scale job creation, and you also need to think about macroeconomic stability in form of currency depreciation as well as inflation. A few case studies around the same. So when you look at from a growth perspective and you look at the economic history of countries around us, one thing clearly stands out that their high growth phase has always been correlated with the growth in the manufacturing sector. Take an example of China from 1990 to 2005, when they were growing at the rate of 10%, their share of manufacturing increased from 9% to about 32%. Same example, Vietnam, which is a very recent success story. In from 2010 to 2022, they grew at a rate of 6%, but they could grew by that rate when manufacturing grew from 19% to about 26% in their GDP. India, as other countries have done, the share has to increase from 15 to 20% to deliver the growth of 7 to 8%, what we have spoken in the past. Manufacturing is also required for job creation because that itself is very important from a political and social stability. 45% of our labor force is actually involved in agriculture. So we have about 25 odd crore farmers. But out of those farmers, roughly about 5 crores actually have some production surplus, which they sell in the market. And remaining 20 crore farmers are doing farming just for sustenance basis, which means they grow, but they consume, and they're hardly adding any economic value in the GDP. This is something, it is there in the policy making's minds, and which is why they are focusing on this particular sector. When a person move from farm to factory, he can increase the output by 4 times in terms of economic contribution. So think of like a farmer, if he's doing the farming, and this is the RBI data that says that you are adding a value addition of close to 70,000 rupees. But the same person when moved to factory, it can add value addition of close to about 3 lakh rupees, and that is what the real opportunity is. This is not a new template. China have done historically. In 1990, China's GDP per capita was $300 at that time, similar to where India was even then. But the share of population which was involved in farming was roughly about 25-26%. Today, that number is about 7-8%. But during this phase, what has happened is that $300 GDP per capita has actually moved to about $12,000 per capita. China has become a upper middle income country just by moving people from farm to factories. And this is also one of the reasons why we need manufacturing and why government is focusing so much about the same. Finally, as a country, we always have a choice of importing. We can say we continue to import. But when we reach a country of such size at our consumption level, what it creates is, a macroeconomic stability, especially in the time of geopolitical uncertainty or global volatility. 2013, we should not forget, it is not very far in the time. India was among the top, among the five fragile countries. The five fragile countries was the name given to us at that point of time. And if you think about at that point of time, the real reason was the current account deficit. Our imports were unsustainable, and there were scenarios where people were talking about we probably even have to go back in time and maybe pledge some of our gold and maybe sell our gold just to be come out of that fragile five. But when you look at the two manufacturing powerhouses, what we discussed, China and Vietnam, in the last 10 years, they have had a much lower inflation than India. Their inflation was about 2 to 3% when we were at about 5.5%. But keep one thing in mind: when our inflation has been 5.5% for the last 10 years, oil prices has been very, very benign, which means that if any geopolitical events were to happen, that oil price could become a risk for us and could be a problematic situation from our country's point of view. Hence, a current account deficit needs to be met and exports needs to be created. That can happen only with manufacturing. Another important point around the inflation. Look, when you keep importing and our currency keeps depreciating, that means that we have this element of sticky inflation in our economy, because in local rupee terms, our imports every year is going to get more expensive, and therefore the inflation will never go away. In that scenario, also, when at country of our size and economy of our scale, manufacturing starts to make much more sense as compared to importing from many other countries. So why we think the time has come for the manufacturing? Frankly, it's not like one factors. It's enabling several factors have come to say that it's we are really at the cusp of the cycle. If I were to sort of, and this is probably a multi-decade opportunity. If I were to just summarize in really this entire presentation in one slide, we can say that we have an opportunity. We have an opportunity because we have a very large consumer base, and that has given us the scale. Now, because of this scale, we've also become competitive in the world market at a time when people is talking about China plus one. So that's an opportunity we can capitalize on. Why we can capitalize on this opportunity is because we have capability. What we need is large and skilled labor pool, which is what our country has, and also that has given us cost advantage versus our peers. Finally, our infrastructure has improved tremendously over the last 10 odd years. We'll go through some of the examples to sort of understand that how that has also given us cost competitiveness. And finally, we have a very favorable environment to capture both this opportunity and capability. When you look at government's focus about Atmanirbharta, that has been all-time high. Policies like PLI, policies like phased manufacturing program, and there are clauses where they are promoting more and more insourcing by putting insourcing norms for various sectors. And finally, even if the government was to not there, when you look at the corporates, they themselves are sitting at the healthiest balance sheet we probably would have seen in the last 15, 20 years. Banking system is virtually free of NPAs, and our capacity utilization is also at a very high level, which means that if we were to continue to grow for the next 1, 2, 3 years, we need to start planning those capacity in advance. So from a cycle point of view, we are at the cusp, which can play out in the next couple of years. Capital is no more constraint for growth in that sense. Uh, Going back to our point of that why our consumption has given us a scale. So look, we have become the third largest consumption economy in the world. Not only we are the third largest, we are actually the fastest growing consumption economy on the world, and because of that, we have gained scale. You look at most of the products, we are either among the top three or the top five markets from a global perspective, and that has given us the scale to be cost competitive. Take an example of mobile phones, smartphones. In 2013, we were the sixth largest market outside China, and we were selling only about 45 odd million phones. Today, that same number is close to about 15 million, and that number is also sort of increasing over a period of time. Another example one could look at is the room AC. When you look at the number of AC what we were selling in about 10 years back, it was only about 3.3 million ACs, which means that even if you wanted to put a factory, because to put a cost competitive factory, you need roughly about 3.3, you need a scale of about a million odd, right? Which means in 2013, you could have put roughly about three factories and you were done. But today, you can put almost 9, 10 factories of similar scale, and the consumption is growing about 12, 15% every year. It's like saying that we can put about a factory every year to meet our demand growth. And the same story continues across many products. Whether you look at washing machines, whether you look at refrigerators, or even cars, this consumption is actually giving us the scale and making us much more competitive. Finally, from an export point of view, our country has become cost competitive. So when you look at our country's cost vis-a-vis US, today we are about 15% cheaper versus US. This is based on the BCG's Global Manufacturing Cost Competitive Index, which they have been measuring for almost 10 years in now. And look at the chart on the right-hand side. China is only about 4% cheaper than US. China used to be about 15% cheaper in 2000 to 2010-12 onwards, and which means that we are exactly at a point of time where China was in 2000, which is where it started to gain market share from the rest of the world. Not only this, we have to speak about the tariffs also, because if you include the tariffs that has been put on China, China actually becomes more expensive even compared to US. But why people are talking about the moving of the supply chain? Frankly, it's not a boxing match between China or India or China versus Vietnam. We need to think it from the perspective of importers, which is a US and a Europe. So when you look at US, what you need to sort of understand is they are looking for an alternative supply chain. When COVID hit in 2020, and even in 2022, which was almost 16, 17 months from the time COVID has played out, there were car companies in US which were not able to sell their 35 to 40 lakh rupees car in the market simply because those were in the semi-finished condition. Why they were in the semi-finished condition? Because a small 200 and 250 rupees part that was imported from China was missing. Why that part was missing? Because that happened to be coming from only two vendors. Both the vendors happened to be in China, in the same city, and even in the same industrial complex. So world has now moved from just in time to a supply chain resilience, which is why they are looking for alternative supply chains. Similar has already started to play out. So when you look at China from 2018 to 2023, they have lost market share, but the largest beneficiary has been Vietnam, simply because some of the Chinese factories were moved to Vietnam. But that is also changing at the margin. Vietnam is facing labor issues in terms of availability, and second is that because the countries themselves are looking for alternative supply chain, not only from an economic point of view but also from a geopolitical point of view. They're looking for reliable partners, which means that India is also coming out as a favorable geography for them. In terms of our capability, in the next 20 odd years, we will add roughly 150 million people to our working force. None of the other countries come even remotely close to us. And most of this labor is coming at a very competitive wage cost. So, for example, China is roughly 5 times more expensive as compared to India. Even Vietnam, which is our competitor in many sense, is 50% more expensive. If I were to show you this chart in 1990, there would be three alternatives that would emerge. That one would be China, one would be Eastern Europe, and another would be India. So India is always there. But look, we missed the bus. Other two geographies and countries took quite a benefit of the same. But if you are a Walmart, you could have gone to either China or Vietnam, or for that matter, Eastern Europe at that point of time. But when you're looking to move your supply chain today, there are not many alternatives available, and in that context, India sort of come out as a favorable place. Not only we have a cost-effective labor, we also have a very large pool of skilled labor in form of STEM graduates and English-speaking population. So when you think about the engineering and the science graduates which comes out of our country, the number is higher than the combined of China and US both put together, and that is also helping us to again not only competitiveness versus our peers, but a reliable uh, as an alternative, as a reliable supply partner to the rest of the world. So which are the sectors that could sort of benefit? I mean, obviously, chemical, pharma, machinery, electrical, electronics, automotive. But you have to see through that what is the common thread across these industries. The common thread is it requires both skilled and unskilled labor. A chemical plant would require people on the shop floor, but it also requires chemical engineers to do that R&D and figure out a new process for a new molecule. The same logic applies for pharma, even from industrial machinery. A lot of prototyping, a lot of R&D work has to be done before the product becomes commercial, and which is why you need those engineers. And we have both skilled and unskilled labor, which is why probably our country is scoring favorable in terms of the realignment of the supply chain. Our infrastructure has also improved by leaps and bounds. In railway, government was spending roughly 20,000 odd crores as a railway budget just about 10 years back. The same number is now close to about 2 lakh crore, even higher than that, which means that our railway budget, our railway spending is increased by a factor of 10. Some of benefits have already started to accrue to us. You were sending your container to a port in Gujarat, it would take roughly about 3 days, and that's just an average time. which means that someday it will take 2 days, someday it may take even 5 days. So there was no reliability. What exporter or what importer requires from another country from a reliability point of view is not only the cheapest good, but also a sustainable and a reliable supply chain. Now you have these trains on a scheduled basis, which leave many of the container terminals from various parts of the countries, and within 24 hours they tend to reach to the ports. And they do that on a daily basis, on a weekly basis, on a monthly basis. So there is a schedule, there is a reliability which has come into the play. Similar example goes for ports. Imagine if you were a manufacturer and you were importing your raw material from any part of the world. By the time the container would come to India and it would exit that port, an average turnaround time would be closer to about 3.5 to 4 days. The same turnaround time has now reduced to about 2 days. There are ports which are as competitive where they are being able to move this container in a day's time. This is, in fact, in many of the ports in our country are actually more competitive in on this parameter even compared to China. We look at the same example at road. An average truck would travel roughly about 190 odd kilometers in about 2015. The same trucks is traveling about 250 odd kilometers because there's a GST reforms that has happened. The number of checkpoints have been reduced, and obviously the roads have become much better, allowing you to travel much longer on the same distance. Similarly, we used to have peak power deficit of roughly about 17% in 2013. Last year, the peak power deficit was close to zero. So a lot of things have come into the play. Not only our cost competitiveness, but our reliability is also improved, which allow us to take benefit of this realignment of the supply chain, which is currently going on. Another question always comes is that look, all this is fine, but it's largely the low value add manufacturing. I think this is where India is uniquely positioned because we have a very strong service ecosystem. It is very likely that even the high value added manufacturing would come in a much accelerated way in the coming years. A recent example is semiconductors. We have been forced to reckon when it comes to semiconductor service ecosystem. 20% of the world's chip designer are based out of India. A company which you would have heard as Qualcomm, which supplies these processors and many of the parts of your mobile phone. 35% of their employee base is actually based out of India. The moment government announced the support to the semiconductor industry, what you observed was that number of companies were willing to do joint ventures with some of the Indian companies and participate in the same. So once those factories gets completed, that could be in the next 3 to 5 years, we would have a integrated manufacturing ecosystem for the semiconductors, and this is probably the fastest any country would have done in over a period of time. So which means that once things starts to fall in place for our country, we tend to be among the fastest one to grab those opportunities and build ecosystems around the same. So high value add manufacturing would also come in our way in the coming years and the coming decade. Government support for these sectors has been tremendous. PLI, there have been 14 PLIs for various sectors, and some of the PLIs has been extremely successful. As a result of which, we are currently doing incremental production of what 6,75,000 odd crores, and we have exported close to about 2.5 lakh rupees worth of exports because of this PLI support. Same example goes even for tax rates. Until March 2024, manufacturing companies were has a very favorable tax rate of 15%. We don't know whether the tax rate will come back in the coming budget or not. But even if you assume the tax rate remains at current level, which is 22%, what you observe, it is as competitive as any other peer would have versus us. So even from a tax perspective, government has ensured that our sector has remained quite competitive. Finally, government is putting a lot of policies around the local sourcing. So when you look at defense, for example, right, it is expected that defense production would increase by a factor of 4 times by 2030, and even our export would also increase by a factor of 10 times during the same period, right? That is possible because government is saying that look, many of the products, many of the defense systems has to be manufactured in the country. This kind of policy support was missing, and not only in defense, it has come across many sectors. For example, many of the multinational brands, which when they're selling their goods through Indian markets, Indian stores, there are local sourcing norms that up to 40% of things what they sell in the country has to be sourced locally within the country. That is also supporting the manufacturing ecosystem. Finally, from a corporate's point of view, as I highlighted, we are at the cusp of a new cycle simply because that when you look at the utilization level in our economy, it is reaching close to about 75% level. Last time when we were above that level, we saw a capex cycle started in 2009 onwards, and then utilization fell because the growth was slowed down at the global level, and we were not even an exporter at that point of time, or not a large exporter at that point of time, and our consumption also slowed down. But now we are looking other way around. We have a very robust consumption economy in our country. At the same time, probably export would also pick up for us, which means that if the capacity is going to get created, it probably would see a much accelerated, improved utilization level as compared to the previous cycle. And this is coming at the time when companies are looking at extremely healthy balance sheets. So there's no constraint for capital. Even banking system is virtually free of NPAs to provide them capital. And even capital markets are robust from an equity capital point of view. They can come to the markets and raise money. In the last 2 3 years, we have already seen the number of companies from the manufacturing sectors coming for IPOs have increased significantly over the previous decade. The entrepreneurial spirit is also very high when it comes to manufacturing. The share of manufacturing companies in the new registration has reached to close to about 30% now. This number used to be only about 20% just about 7 8 years back. The manufacturing FDI is also picking up. When you look at the manufacturing FDI, it is reaching a level of close to about $15 billion on an annualized basis. And this is also a number which is in a rear view mirror, right? Because many of the projects like semiconductors and some of the large project announcement that happened in the last 3 6 odd months, the capital flow would happen over the next 1 2 years, which means this number is also going to accelerate. Why this is important is that when China opened up its manufacturing base for the rest of the world, the first leg of the exports were actually driven by the MNCs. The share of manufacturing exports from MNCs was close to about 60%. Over a period of time, local champions, local companies became large, and that share has now declined to about 35%. So many large local companies become much larger. I think a similar template probably would also play out for our country as well in the coming years. A few case studies where India has been quite successful and where manufacturing has been quite successful. I mean, obvious example comes into the mind is mobile phone. In 2015, we were importing close to about 80% of the mobile phone. The same number is now about 4%, and I think in the next 1 2 years, this number would probably go to zero. Not only that, we have become the fifth largest exporter of mobile phone in just about 5 6 odd years, and we would be probably among the top three in the next 2 3 years, and probably the largest exporter of mobile phone in the next 5 odd years. If I just go by many of the announcement which has happened in the recent years. Apple is a great example that how once the MNC starts to come into the ecosystem, how the growth is always rapid. So look at in 2021, Apple was importing only 3% of their phone shipments from India. When I was making this PPT, the number was about 10%, which was about 9 months of data of 2023. But last week there was an article in newspaper suggesting the same number has improved from 10 to 14%. So from 3% to 14% that has happened in roughly about 2.5 years. That is the level of growth that starts to happen once ecosystem starts to build up. Samsung did the same thing for Vietnam, and we have both Apple and Samsung contributing in the manufacturing story of our country. I think it's over a period of time, it's only going to get accelerated, and even the component ecosystem would follow after the assembly in the coming years or so. This is an example where that whenever an ecosystem has developed in our country, we have become a force to reckon with. Look at pharma. Every tablet in US which is getting sold, and that is a generic tablet. Every second tablet is actually coming from India. So India's share in their volume is about 50%. Even when you look at auto components, we were importing close to 2.5 billion just about 5 years back. The same number is now virtually close to zero, and actually we've become a net exporter. India is the largest manufacturer of three-wheelers. It is the largest manufacturer of tractors. It is the second largest manufacturers of two-wheelers, and third and fourth largest manufacturers of trucks and cars. And this scale probably would continue to emerge in the coming years. Here are some of the examples where we have been able to reduce our import bill through manufacturing. So look at room air conditioners. In 2018, we were importing roughly about 13 14,000 crores of components and finished goods. If you divide that by the number of ACs that were getting sold that year, the number comes to about 16,000 rupees. The manufacturing value of an AC, on average AC, is close to about 20,000 rupees. which means that when an AC was getting sold in our country, we were importing 16 to 17,000 rupees worth of components from the rest of the world. Today, that number is reduced to about 6,000 thanks to PLI benefits, which has flown through in the economy. And you can identify why that number is 6,000. That's a compressor which goes into the room air conditioner. I think in the next 2 3 years, even that number will move close to zero, because many of the MNCs have started their plans to build those factories, and in next 2 3 years, once those factories gets completed, not only will become our net imports will go close to zero, but there are companies like Daikin, there are companies, many MNCs, we are talking about exports. We probably would start exporting room air conditioner in the coming years or so. A similar story is played out in toys and gaming, where our imports have declined rapidly and our exports have started to increase gradually. EMS is an industry which did not even exist a couple of years back. There are many companies, we were doing revenues of about 200 to 300 crores just in 2016. And this year we are talking about a revenues of about 17 to 1800 odd crores. So this is the level of growth that has come in these sectors. And some of these sectors would continue to grow over in the coming years, simply because this is just the beginning. We have just started to gain share from many of the geographies in this world. This is an example where we have gained share from China. Tiles is an example where China has been losing market share from 2014 for various reasons. Their pollution norms, they have become cost uncompetitive because tiles requires a lot of labor. Labor is a very important part of the equation, and because the labor is getting expensive, India has started to gain share. There's a region in India, it's called Morbi in Gujarat, in Rajkot district. It has emerged as one of the largest ceramic hub globally. The same similar story has played out in cables and wire. Our exports have virtually doubled in the last 5 years, and in fact, our growth rate is accelerating. So, if you notice, last year's growth rate was north of about 40%, and we probably would see as new capacities starts to build and they start to get finished in the coming years or so, the export is going to only accelerate and not accelerate. On specifics around the this fund, so the investment strategy first about the portfolio. At least 80% of the portfolio would be invested in the stocks that would be represented and in a much diverse manner and exposed to the themes of the manufacturing. The stock selection is the bottom up. It's not that we are deciding on a top down basis. Look, these are the sectors that are growing. It's the other way around, because we have a very strong research team. We have the ability to do the stock picking from a bottom up basis and look at the sector allocation from a risk management point of view. So the investment style is largely going to be from a bottom up stock selection. Invest money in the companies that would have a long runway for growth at a fair price. When we look at portfolio concentration in market cap, this would be a reasonably well diversified portfolio, and it's market cap agnostic. It would be flexible. It would be flexible across market cap. So it's not a large cap only, or a small cap only, or a mid cap only. It would be flexible. It will be flexible across market cap. To give an example, if you look at the number of companies that can qualify for this theme, and just putting a constraint of about let's assume only let's consider companies above 1,000 crore market cap. So then 700 odd companies would qualify for the same. I'm not saying that we will invest only in companies which is greater than 1,000 crores. We may choose to invest in the companies which may be even below 1,000 crore. But this is just for an illustration purpose, just to highlight that the number of companies in the universe is quite large, and your ability to do the stock picking is also very high. And these companies are quite broad based and distributed across sectors. The largest sectors would be capital goods, but the aggregate weight would be about 17%. Many other sectors have the similar weight, like oil and gas and automobiles. Healthcare also would be about 12%. So when you look at the sectors and when you look at the number of industries within these sectors, it's quite large. So it's not that you are taking exposure to one particular sector on one particular theme. You have a list of about close to 80 85 odd industries which qualifies for the theme of manufacturing, and the portfolio construction would take care of that part, that the money is invested in a much broader and diversified manner than in a concentrated manner. And finally, on the market cap basis, when you look at these same companies from two dimension on a market cap weighted, then you would notice that roughly 55% of the companies are in the large cap domain, and remaining 45% is evenly spread between mid and small cap. So let's say for a simplicity, one could argue half is large cap and half is mid and small cap. But if you were to look the same thing from the number of companies, we have about 43 large cap, which is about 43% of 100 large caps we have. When you look at mid cap, that is 76 mid caps that qualify for manufacturing theme. That is again about 150. That is almost about 50% of 150 mid cap companies we have in the overall market. And again, obviously, small cap is a much broader universe to sort of choose from. Uh, just to point out the negative list, that what will not constitute part of the manufacturing theme would be the services. So financials will not be considered as part of the manufacturing theme. IT services will not be part of the manufacturing theme. Some of the business services will not be part of the manufacturing theme. We are also calling out that the diversified consumer names, like for example Hindustan Lever or ITC, such names would also not be part of the manufacturing theme. A few examples around the risk and mitigants. The biggest risk to this manufacturing sector is obviously any slowdown in the growth, simply because manufacturing ultimately is linked to the economic growth. So if there is a global slowdown or a local slowdown, there would be impact on the same. Having said that, I think if there is a global growth slowdown, while there could be a near-term impact, it actually could be a blessing in disguise over a medium term, simply because whenever global growth slowed down, there's a lot more focus on the cost, there's a lot more focus on the offshoring, and therefore India may end up benefiting from the realignment of the supply chain. There is obviously also threat around the pace of the reforms and the implementation of policy initiatives. But when you look at the government policies now, this seems to be more favorable than not, and that goes back to our original discussion that why we need manufacturing. We need manufacturing for growth. We need manufacturing for employment creation. We need manufacturing for macroeconomic stability. I think this level of policy push is more likely to continue, and therefore there are enough mitigants sort of put in the place. There is obviously a discussion around the automation and AI. I think India, while automation and AI in the near term can lead to slower job creation, but what you notice that over a long period of time, all these forces tends to be deflationary. That brings the cost of the consumption down. When the cost of the consumption starts to decrease, what we see over and over different periods of time, that overall consumption tends to increase. Which means that even if there were to be automation and AI, probably our consumption would take care of our consumption would increase because of the reduced cost. And frankly, it's not that India has to remain behind the automation. You have to remember that what is required for automation and AI is a very strong software development ecosystem. And as we discussed in the beginning of our presentation, that because India has a very strong software service ecosystem, there is no need to believe that we would be left behind. In fact, we could be see examples where some of our companies could become a supplier of that automation and the AI technologies to the rest of the world in the coming years. Finally, if I were to summarize this entire presentation in this one slide, and this why invest in India manufacturing, it's an Amritkal story. It offers an exposure to multiple themes, as we call it. It's a theme of themes. So when we look to invest in India, what essentially we are looking for is theme of consumption, theme of investment, increasing capex, and theme of exports. Manufacturing theme allows you to capitalize on all those three forces. There is changing geopolitical situation. People are looking for alternatives, and India is emerging as a favorable destination for the same. So it allows you to take exposure for the same. And finally, India is emerging as a manufacturing powerhouse, as we saw through various examples. Why now? When you look at the government policy push around the self-reliance about Atmanirbharta, it has been, one could call it as an all-time high. We have never seen such kind of push to towards manufacturing in last so many years. So that's very supportive. Not only government, when you look at our macroeconomic environment, that is quite favorable because our capex start to increase. The company's balance sheets are quite healthy, and this high level capacity utilization. So we are at the cusp of that beginning of cycle. So that's also important from a timing point of view. Finally, the largest pool of cost-effective labor supply, India is supposed to reckon with in the same. This global realignment of supply chain, it's linked to the previous point, and I think even the high value-add manufacturing that probably is going to accelerate in the coming years, which is why we should look to invest in the theme now from a timing point of view. I'll stop here.
Uh, Ram, I would just summarize or conclude this way that government responses generally are in response to the need of the hour. So, to give you another example, during decades of 90, when India had a challenges on the foreign exchange front, the response was to promote export industry, software industry. And that's where all kinds of incentives were provided to those industry so that you get a comfortable position as far as FX is concerned. Today, as I said that earlier, that FX is a very comfortable position, $650 billion, and one of the record highs as far as comparable positions are concerned. But what is the need of the hour today? Is to provide job opportunities, to transfer people from farm to factories, to provide better infrastructure, to improve logistics, to improve production, so that the rising consumption need of the population is met domestically and not by imports. And therefore, all the policies, programs, reforms of the government are in that direction to shore up the manufacturing or to make India a manufacturing powerhouse. Somewhere a couple of decades ago, when we were focusing more on services and software, we ceded that place to China and China became factory of the world. Now the situations are emerging, which is making India a conducive place to manufacture in terms of its cost effectiveness. And therefore, the government is aware about this opportunity, wants to seize this opportunity, and therefore are moving swiftly in that direction. And therefore, I said also earlier, inviting Apple, Tesla, and so many global majors in this country are a step in that direction. And at the same time, encouraging Indian entrepreneurs to become bigger and bigger by having PLI schemes. So this government is actually saying that you produce more and take more incentive. So therefore, they are promoting scale. And therefore, we believe that Ram, as you said, that it is manufacturing going to be the fastest growing segment in a faster growing economy in the world, and therefore the opportunity. So that's what we had this offering for you, and request you to take a look at this offering in a detail and to extend your support. Thank you very much for being on this call. Thank you, Rakesh. Thank you, Ram. Thank you, Siddharth.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.